Hello, everyone, and welcome to the Small Cap Insights podcast powered by Darrow Associates, which is a leading full service investor relations firm that's primarily focused on micro and small cap equities. My name is Alex O'Toole, and today I'm joined by Shawn Kravetz, the president and chief investment officer of Esplanade Capital. Shawn, thank you for joining me.
Nice to be here, Alex.
So, for starters, tell me a little bit about Esplanade Capital and what sets you guys apart in the market.
Sure. So I founded Esplanade Capital just over 26 years ago here in Boston. I used to refer to us as the world's smallest hedge fund. We are still a boutique investment management company focused on a handful of sectors. We do a lot of work in retail, and we do a tremendous amount of work in renewable energy. We are value oriented and also invest in growth at a reasonable price, and mostly micro cap and small cap companies.
So, you just mentioned you founded your company back in 1999, which I'm sure in many ways feels like that was lifetimes ago. What do you know now that you wish you knew then? And what advice would you give yourself back when you were starting this new venture?
Sure. So, piece of advice number one is don't start the world's smallest hedge fund on the eve of a 40% decline in the S&P 500. Though we were very fortunate, we made money from start to finish. It wasn't pretty, but it's just too hard. And it's a good example of the serendipity and the importance of timing when you're starting any venture, but certainly a fund. If the markets are your friend, then it makes you look smarter than you are. If they're not, it makes you look maybe not quite as smart as you are. But since then, incredible learnings every year, every quarter, every month. I think the biggest single one is just to know who you are, remain consistent in your process, make sure that your investors are highly aligned with who you are in your process. And when you do that and have the luxury of some time, good things tend to happen.
That sounds like fantastic advice for really anybody at any stage in their career
I agree.
at this point. So, your firm, in your own words, specializes in smaller companies, out of favor and below the radar companies, special situations and turnarounds. How do you differentiate between companies that are flying under the radar and worth your investment versus the ones that you should pass on?
That's 90% of what we do. Our office is more like a library than a trading floor because it is the synthesis of real work and deciding what is, truly cheap versus just less expensive than it used to be. You mentioned some of the watchwords of our investment philosophy. We sometimes talk about ouch stocks. Those are stocks that are out of fashion, undiscovered or underfollowed, cheap, and sometimes hated. And though all of our investments don't embrace all of those characteristics, they almost always embrace at least one or more. And these are companies, typically good companies trading at great prices or decent companies trading at unbelievable prices, where we can do the work, the real research, analysis, and insight generation, and say this is more than just a stock that's 30% lower than it used to be. This is actually a compelling value that we think can compound, hopefully in the next year, two, three, or beyond.
So, what is the formula that you use to the extent that you're comfortable sharing, both for your clients and even for yourself when you're building out an investment portfolio?
So we very much think about, at the end of the day, cash and cash flow. That not only tells the story of the real lifeblood of a business, but it's eventually how investors will get paid. So we are always thinking about cash, free cash flow generation, et cetera, et cetera. But importantly, we also look at businesses from a valuation perspective, one in a different way that can, we think, help advance our cause and help eventually make our investors money. Maybe that's a sum of the parts valuation, maybe that's replacement value, but maybe it is how traditional industry metrics are used. And that is always the second thing we look at, which is how do we think most investors are valuing this business? Because if everyone's enterprise value to EBITDA based or revenue multiple based, and you're not, you're going to miss something. And finding those opportunities where maybe the traditional metrics have gone awry, but you see value or perhaps lack thereof, that other people aren't seeing. When you marry these valuation methodologies, that's generally how real insight is created. But at the end of the day, we are looking for cash flow, net present value, real value. And thus, it shouldn't surprise you that we have a real value and growth at a reasonable price orientation. We're not going to try to get our heads around is SpaceX overvalued or undervalued or fairly valued, OpenAI, et cetera, et cetera. The list goes on.
So how much of that strategy and kind of approach did you know going in when you started this versus did you kind of learn along the way that this is kind of what was going to yield the best results and what was going to set you guys apart?
So very much both. Prior to founding Esplanade, I was an executive and I was a management consultant. And as a consultant, we worked with great management teams around the world using, though we sometimes had access to non-public data, part of our job was using data that everyone had available just to see things a little bit differently, to generate a little bit of insight where there wasn't some before, even with very smart, very hardworking management teams who had been there for 10 or 20 years. So, this sort of insight orientation, this owner's mentality, even when we were just consultants and not owners of businesses, that was there from day one. Almost a private equity view of the world, but with publicly traded stocks. Since then, for sure, we've continued to sharpen the tools of research and analysis to try to waste less time, to try to have fewer and fewer errors, and try to get to our conclusions sooner with less variability and less risk. And that process is never ending, though we are not necessarily the most technologically savvy firm in the world. Again, starting to use real AI tools to do more work faster, to do better work faster, to cover more ground, to make fewer errors. Again, that's just part of the consistent learning and evolution of our small firm.
So tell me a little bit about those real AI tools that you've started to use and how you kind of saw fit to start incorporating that into your workflow.
So, when AI started to become more in sort of the common dialogue in the investment world, the automatic knee-jerk reaction was, what can we buy in terms of stocks that will benefit from AI? What can we short of stocks that'll be hurt? And of course, we think about that quite a lot. The problem is, given our value orientation, we're not going to be interested in some extraordinary world-changing companies that might be undervalued, but if they're trading at 50 times revenue, they're not going to be for us. We try to do that work, but really bring it back to how can we use AI tools just to do our job better? And through, I would say, rudimentary use of Claude, Perplexity, Chat, and other AI tools, I'm just able to do more work faster from my office in front of my Bloomberg or on my couch, things that a few years ago I might have asked an analyst to spend a week or two doing. I can literally have, it's not even 90% of it. In a way, it's 90%. In a way, it's 110% of it at my fingertips in 15 minutes. And that's an extraordinary game changer. We used to create these one-page tear sheets that would take days and days to prepare to get right. Today, we can have them in 5 minutes. They still require judgment. They still require work. They're not as good as a great analyst, and I hope they're not as good as me, but we can turn over more stones, kiss more frogs, go to the third level of analysis, whereas before we used to have to decide after the first level of analysis, do we keep working and spending our precious time on this, or do we just kick it to the curb and move on to the next? Now we get to do more work, and once in a while that turns up something that would have failed the first screen, but after you do two or three, all of a sudden it's worth more work, it's worth meeting management, etc. So it's really unleashed a lot of productivity for us.
It sounds like it lets you really focus more on that important work that only you or a human, in my opinion. I kind of think that AI is, like you said, a useful tool, and it's interesting to see those real life applications. And yet, you still do need that human component, right? You have to have those human checks, and that's how we kind of marry those two things to keep ourselves invaluable almost, you know?
The judgment is more important than ever. The looking across the table from the CEO or the CFO is more important than ever. Deciding, what's a hallucination, what isn't. Again, it's very easy to get carried away, but that's part of why I love this job because the a lot of the very important bits and pieces are more easily done than ever, and that can free me up to go visit headquarters, to walk the mall, to see the solar farm, to use that judgment and experience to say, we saw this before 10 years ago, or we know this management team and they are excellent, et cetera, et cetera. And I think that's a really wonderful combination.
And touching on that kind of human piece, like you said, you like to really go in person to have that human touch with the investments and kind of know where it is that you're putting your money, your client's money, et cetera. So does every client get an individualized strategy based on their own personal goals or values, or how do you go about that?
We know. So we managed pooled vehicles and hedge fund structures. And so what's good enough for me and my family is exactly what you would get, Alex, as an investor if you were in our fund. It is not bespoke or tailored. We make one set of decisions. And actually, I think that's important. A lot of funds talk about, we eat our own cooking, and that is incredibly important because whatever food I'm serving you is what I should be eating at home. We've also talked about in the past at Esplanade, we're also a little bit of where the chefs eat. When you go to a new city and you can have the Michelin guide and, all of these different guidebooks for where you should go for your special dinner out. Maybe the most important thing is where do the local chefs go to eat after they've worked in their kitchen all day? And we've been very fortunate over the years. We've had a handful of other investors who are great investors in their own right, and they have chosen to give some of their capital to us. To me, that is the highest compliment in the world.
Yeah, I agree because that actually is exactly how I like to travel and exactly how I like to eat. I ask anyone I know from there, I'm like, where would I go if I was a local? I don't need to be in the tourist traps. Where do I
That's
need to
right.
go if I was a local? So that's actually, I think, a great way of explaining that. And again, you said if it's good enough for me and my family, it's good enough for everyone. So everybody in that way is kind of getting that really personalized touch of you really are invested because this is how you're doing your own investments.
That's exactly right. But the edge of that is that makes the funds that Esplanade manages not right for everybody. And that's fine too. And so we've tried very hard. We're a small firm, but we've tried very hard to make investors self-select. Again, you hope that you always under-promise and over-deliver. These funds have to be right for the investors. And if they're not, that's absolutely fine because it's not one size fits all, but we do our best. And that's the cooking that every investor in the fund eats, including me and my family.
I think under promising and over delivering is just a great motto to kind of go by in life. I very much take that on board myself.
Agreed.
So, keeping an eye on the time here, is there anything you think that I've missed or that you would like to touch on?
The only thing that comes to mind, Alex, is, for years, it's been a struggle for micro and small cap managers. The unbelievable success of Mag 7, of large cap tech, et cetera, has been incredible, married with and highly related to the indexation of the world, where more and more of US and global equity assets are indexed. And not surprisingly, that feeds larger and larger S&P 500 style companies. For sure, that's a trend and not one I recommend anyone get in front of like a steamroller. With that said, these companies, and they are extraordinary companies, and not all of them trade at crazy valuations. Some do, but some don't. They can certainly go higher. With that said, over the next 5 to 10 years, not necessarily 5 to 10 months, but 5 to 10 years, I do think it's going to be very difficult to generate eye-popping generational returns with companies at these levels. It would require these $3 trillion market cap companies to be worth 6 or 9. They start to look like the US GDP. And so, again, well under the surface, I think there are going to be more opportunities than ever among smaller, underfollowed, underappreciated, maybe at times turbulent and volatile, smaller securities. That's where we've made our living primarily for 26 years. And I'm not saying we're entering a golden era for small caps, but I think it might go from being a tarnished era to being a compelling era. And that gets me very excited.
Yeah, it definitely sounds, just from the way that you are explaining it, it definitely sounds like it. So one last super quick thing before I let you go, because I do want to be conscious of the time. You kind of walked us through a lot of where you are now, where you've been, how long you've kind of been at this. So take us back to the very beginning. What was the first job you ever had when you were a kid?
First job I ever had was actually being a little bit of a serial entrepreneur. Like I did uh, little fundraisers for charities. Someone was generous enough to give a bunch of school supplies, pads and pens and erasers and notebooks, and held a little store at my public school where we sold all these things for charity. I love things like that. I love little carnivals and yard sales in front of my house, small businesses like that. That's where the rubber meets the road. And at the end of the day, all these stocks, they're about businesses with real customers, real products for sale. And that's the entrepreneurial and business DNA I grew up with around the dinner table. And I hope I carry some of that uh, into every day here at Esplanade Capital.
It sounds very much like you've kind of always had that entrepreneurial spirit in your blood. And like you said, you go directly to the consumer. You want to help those smaller things and give back to people. And it sounds like that started from the very beginning for you, which is
A
great.
long time ago.
Yeah, amazing. So, Shawn, thank you again for making the time, and thank you all for listening. Again, that is Shawn Kravetz from Esplanade Capital. This has been Small Cap Insights Podcast, powered by Darrow Associates, and I'm your host, Alex O'Toole. I'll see you all again next time.
Thank you, Alex.